What if this did not have to be your permanent reality right now? What if you could wake up whenever you wanted and have unlimited time to spend with your family or work on your favorite hobbies? Most of us were taught a massive lie that the only way to make an income is to work for money until we die. But there is actually another way, and I am going to share the cold, hard truth with you today. You can either work for money like a slave or you can make money work for you like a master. I am going to share with you 5 specific ways to do that and create real passive income starting today. It does not take $1 million and it does not take any special genius skills. Anyone can do this if they stop being lazy and start acting like they actually want to be free. Let us jump right into the first one, which is dividend stocks. First of all, what is a stock in the actual real world? It is not some sort of conceptual weird thing that squiggles around on a colorful price chart on your phone. It is actually a piece of an actual company that has buildings and employees and real products. When you buy a stock, you are buying ownership in a real-life operating business. A company that has factories and stores and customers and real sales every single minute of the day. By owning a piece of that company, you are legally entitled to a share of that company as profits. At its core, when you buy a stock, you are buying a piece of a cash flow machine. Do not forget that because it makes the whole thing very tangible for your brain. Now, among all the thousands of companies you can invest in, there are some that make a ton of profit. After paying all their expenses and investing back into the business, they have a mountain of cash left over. They distribute this extra cash to the owners, and that is you, the smart stockholder. This is what we call a dividend. Companies will normally pay these dividends on a quarterly basis, which means 4 times every single year. Every 3 months, you are going to get a cash deposit in your brokerage account. You get this money for doing absolutely nothing other than just owning that stock. Stocks that pay good dividends are usually companies that are very stable and boring. We are not talking about risky startups or tech companies that just launched yesterday in a garage. We are talking about giants like Coca-Cola or Procter & Gamble or AT&T. In terms of how to pick good dividend stocks, you need to start thinking. Like a business owner, your ability to receive dividends depends on whether that company stays profitable over the long term. You want to pick companies that have a history of making money for 20 or 30 years straight. You also want to look for a consistent dividend history without any cuts or interruptions. If a company always pays a dividend every single quarter for decades, that is a massive green flag. Something else you must look for is the dividend yield. Dividend yield is a percentage that shows how much cash you get back for every dollar you invest. The formula is last year's total dividend payout divided by the current stock price of the share. The higher the dividend yield percentage, the more bang for the buck you are getting. For example, Johnson & Johnson might pay 3.02% while AT&T pays 5.73%. If AT&T paid 28 cents 4 times a year, that is $1.12 total for the year per S-hair. Divide that by a stock price of $19.37 and you get that 5.7% yield. You want the dividend yield to be as high as possible, but you have to be very careful here. One thing you must watch out for is a yield that looks way too good to be true. Usually, if it looks too good to be true, it is a total trap for your money. It might mean the company is having massive financial issues and the stock price just crashed. I remember seeing companies with 15% yields right before they went totally bankrupt. You want to look for yields that are in line with similar companies in that same industry. Back in the day, GameStop used to pay a really good dividend in its absolute prime, but once online retail started killing their business model, their profits started falling off a cliff. The dividend yield looked high, but if you dug deeper, you would see the company had way too much debt. Anything in finance that looks like a free lunch is usually a scam or a total disaster waiting to happen. To get started with $1,000 is super easy today. Compared to 10 years ago, all you need is enough money to buy one single share. If AT&T is trading at $19.37, you can buy 50 shares with around $1,000 right now. Nowadays, you do not even need enough for a full share because of fractional trading apps. Platforms like Fidelity or Robinhood allow you to buy just a tiny piece with whatever money you have. Number 2 is dividend index funds, which I think is even better for most of you watching this. I think this is a much safer way to get dividends than buying individual stocks. It gives you the benefit of something called diversification. Diversification is when you spread your eggs out in many different baskets so you do not go broke. You do not have to worry if the CEO of one company is a criminal or if a factory burns down. You can just invest in a diversified fund of hundreds or even thousands of different companies. It is like buying the entire flower shop instead of just buying one single rose. Diversification lowers your risk and makes it easier for you to sleep at night as a beginner. When picking the best dividend index funds, the most important thing is the expense ratio. Because it is so convenient to buy a whole basket, you will be charged a management fee. These expense ratios can range anywhere from 0.03% to 2% or more. You always want to look for a fund that has a very low expense ratio. Over time, these tiny fees really add up and can steal hundreds of thousands of dollars from you. I never buy a fund that has more than a 0.2% expense ratio because I am not a sucker. You also want a fund that has a reasonably high dividend yield for that sweet passive income. For example, there is a popular fund called JEPQ, which pays a yield of around 9.74%. Compare that to the Vanguard High Dividend Yield ETF, which is VM at around 2.89%. There is a massive difference there, and there is always a very good reason for it. If you dig into JEPQ, you will see they use options and fancy derivatives to get that cash. That is a great way to generate income, but it comes with much higher risks for your principal. If the market moves in an unexpected way, that fund could realize significant losses very fast. You will not see that kind of danger in a simple fund like VIM. Always read the fine print, because no one is giving away 10% for free in this world. A good rule of thumb is to compare the yield to the current federal funds rate. Right now, that rate is around 5.33% in the United States. If something is paying way more than that, you need to stop and ask what the catch is. You can get started right now with $1,000 in funds like VIM or VIG or SHD. SHD is actually one of the core pillars of my $124,560 portfolio. Now, the third passive income investment you can make is bonds. Bonds are very different from stocks because you are lending money instead of buying ownership. Lending is a much more conservative way to put your hard-earned money to work. You make an agreement to lend money and get paid back at a certain time with fixed interest. It is safe and predictable compared to the wild roller coaster swings of the stock market. The yield is not going to be as exciting, but you will not lose your hair over it. There are different levels of safety even in the bond world. You should look at the bond rating from companies like Moody's, S, or Fitch. It is just like a school grading system where AAA is the best and D is the absolute worst. Anything in the A or B range is usually safe for your long-term savings. I prefer bond ETFs like BND, which is the Vanguard Total Bond Market ETF. This fund holds corporate bonds and government bonds all in one easy place. Remember, this is financial education and not specific advice for your unique life. You have to make your own final decisions about where your capital goes. You can also look into municipal bonds if you want to save on your taxes. If you live in a high-tax state and buy muni bonds, you might not pay state tax on that interest. The fourth investment type is REITs, which stands for Real Estate Investment Trusts. Most people think you need $50,000 for a down payment to own any real estate. That is a total myth, and I am here to bust it for you today. You can start investing in real estate right now with just $100 through REITs. REITs are companies that own and manage a huge portfolio of real estate properties. They are legally required to pay out 90% of their taxable income to shareholders. When they collect rent from tenants, they pass most of that cash directly to you every month. I love REITs because managing a physical rental property myself was a total nightmare. I remember when I first graduated in 2020, I thought I wanted to be a landlord, but then I realized I hate people and I hate fixing broken toilets at midnight. With a REIT, you get professional management and you do not have to lift a finger. You can choose REITs that focus on apartment buildings or shopping malls or data centers. There are even REITs that only own massive public storage units. The dividend yield for REITs is usually pretty solid, but do not ignore the growth. A stock like Digital Realty Trust might pay 3.24%, but the stock price can also double. VTI is a total market fund that includes some of this, but focuses more on pure growth. Always remember that you want both dividends and capital appreciation over the long haul. The fifth and final one is the High Yield Savings Account, or HISA. This is not really an investment in the strict sense, but it is a great place to park your cash. Right now, these accounts are paying around 4.5% or even 5%. These are online banks that do not have expensive physical buildings on every corner. They pass those massive savings onto you in the form of higher interest rates. Your money is FDIC insured, so it is safe up to $250,000 per account. It is very liquid, which means you can take your money out whenever you have an emergency. The balance will never go down because it is not tied to the stock market. If you have money for an emergency fund or a house down payment, this is where it belongs. But for long-term wealth building, you need to be in the stock market and REITs. Over 10 or 20 years, the stock market will crush a savings account every single time. I want to emphasize the power of starting small, even if it feels useless at first. If you invest $1,000 and make $50 of passive income, that is a massive win. That $50 pays for a nice dinner that you did not have to slave for. Everyone starts at zero, and everyone has to make that first scary move. My first dividend payment ever was literally $2 from some McDonald's stock I bought. I was 22 years old and I felt like a genius because I earned $2 while I slept. Now my portfolio generates thousands of dollars every single month without me working. But I would never be here if I did not start with that tiny $2 payment. Do not underestimate the power of starting small because math is on your side. I spent a year living in a room with no furniture just to buy more VOO and VTI. People called me crazy, but now those same people are asking me for a loan. Stop waiting for the perfect time because the perfect time was 10 years ago. The second best time to start is right now while you are watching this video. Stop buying designer clothes and shoes that lose value the second you walk out the door. Buy assets that pay you to exist and breathe. Go open a brokerage account and put your first $100 into a total market fund. If you want to learn exactly how I built my $124,560 portfolio, check the link in the description. I have a free starter kit that breaks down the math without the confusing academic jargon. I am not a professor and I am not a salesman. I am just a guy who realized the system is rigged and decided to win anyway. I will see you guys in the next video where we talk about the biggest mistakes I made. I lost $10,000 on a stupid investment once and I will tell you all about it. Keep grinding and stay hard because no one is coming to save your bank account. You are the only person responsible for your future freedom. Thanks for watching the channel today. I will see you next week with more real talk. Bye for now, and go get that money.